Hello, everybody. It's Max. How's everybody doing? I appreciate y'all for being here. Okay, there is no slides for this, but I want to talk earnings trades, and I want to show you guys how I do it. I want to show you like inside my mind. I've always mentioned before that I want to make a book and call it Options for the Visual Learner, and make an option strategy guide for somebody that's visual. I usually try to teach from a visual standpoint. That's why I use option strat so much. So I have a lesson today. So today after the bell, we have earnings in Microsoft, Tesla, and one of the other ones, Microsoft, Tesla, and Facebook, Meta. Okay, so let's find a bullish trade for those three stocks, and then let's hedge it with a Q put spread strategy. So we're going to do it all at once on the fly, and I'm going to show you how to do it. And then we'll paper trade it and see how it comes out. Powell's getting ready to speak in 15 minutes. It's 12:44. You can see on my thing. So I don't know whether or not it's good news or not. But my theory of this could be a pairs trade, 3 longs and a short. We use NASDAQ shorts, thinking if these things miss earnings, or if Powell says something that makes the market bad, the NASDAQ short should do well. But if Powell doesn't say anything and these things have good earnings, the NASDAQ short will lose money, and it's designed to lose money, but we're going to make enough on the 3 longs with our earnings trades. I'll show you how to do that. Okay, so, but yeah, today's earnings it is Meta. So Meta, I always call it Meta. Facebook, Microsoft, and Tesla. Okay, so let's look at this. I started without you guys. I already made a trade in one of these stocks. I thought I did. All right. Well, anyway. All right. Here's how you do it. So I always start with the bull put spread. What that means is you're selling puts, turn a profit. First, I always start making sure I need a yield. These trades are designed to give you an income. Now, sometimes giving you an income can come at the cost of a losing trade. So we don't want that to happen, but lots of times you can get an income and you can have a winning trade, or lots of times you can get an income that partially protects the losing trade. So right here, what I do is we go to Microsoft, pull a Microsoft, and then pull up, well, the way I show everybody this, in case you've never seen this before, you're basically just trying to sell this put. That's what you're trying to do, but it's too dangerous. You don't want to lose $44,000. Okay, so you add another put to it at a lower strike. Bingo, you got a put spread, and now you have max loss. So then what I do is I'll look for an arrangement here. I like to get about 1/3 of the credit of the risk. So this one, I get a credit of 1,000 for 3,000 of the risk. Now, the second thing I look for is the break even to be as far down as possible. That means the stock could move against me. Microsoft could drop, and it could still be a break even trade. So what I'm going to do is I'm going to slide this down one more. Okay, look, now I got a 5% break even, and I got about a 40% credit. Now I got a 8, 16, 20, about a 33% credit. And so that looks good. So we're going to go with that. But so we aren't going to get this naked. We aren't going to earn the whole 1980, but we're going to try to make 1980 minus 1150. Okay, and that's this number right here. That's 826, and we just don't want Microsoft to drop more than 6.7%. All right, but hey, Max, covered calls and short puts, it's the same thing. Our super caps, you aren't going to be able to make. You don't have any upside in that trade. Yes, I'm aware of that. So what we're going to do is we're going to spend part of this $821, and we're going to buy a single call. And we're going to move it out we're going to move the strike price out to the first standard deviation, the expected move, which is 518. The expected, so we'll move it to 520. The expected move is this hash mark on both sides. So now the problem is we can't do the trade for a credit. That trade's a debit. So we're going to try to do 2 spreads. and only one option. And we're going to move the option out a little bit further to 525. Okay, perfect. So now what do we have? We have a $755 credit for putting the trade on. We have chance for upside if it's it's not that far of a long shot. 20% of the time, about 15 or 20% of the time, it should get beyond that area. So not that much of a long shot, but we built in a huge downside buffer, 6% downside buffer before we lose money. Okay, so we're going to save this trade as a Microsoft, and we're calling this a bullish loaded dice. Okay, now let's go do the same thing to Facebook, and I won't explain it. I won't have to explain it now that you guys know how to do it. It's easy to do, right? Doesn't work on some stocks. Stocks has to have a lot of has to have a real narrow bid-ask spread. It has to have and it has to have lots of option volume to work. All right, so we changed the date to this week because it's all right, and then we start with the put. Remember, we start with just a sell put. We'll move this one. Okay, that's what we're really trying to do, but we don't want to spend that much. We don't want to risk $65,000 or even $13,000. So what we do is we add another put below. We get the ratio where it's about 1/3. Something like that, 801 to visually, you can just tell that's about a 1/4. All right. Then we're going to add a call. We're going to move it down to the standard, to the first standard deviation, which is this hash mark right here. On this one, it's all the way down at 735. The option market makers and the price of the option sets these prices. Okay, so now it's not a very big credit, but we're going to do 2 spreads. Or sell 2 puts and buy 2 puts. So do 2 spreads and buy 1 call. Look at that. $1,000 credit, huge buffer, 3.2% buffer. Let's see if we can make more buffer. Let's try to optimize this. $730 on this. We can get a lot of buffer on this one. This one's one that's working out really well because it has really liquid options with a small bid-ask spread. See, 1080, 1065, 15 cents on something that's $10. That's nothing. That's nothing. 10 cents on something that's $5. That's a great bid-ask spread. So this to me is the best combination of far enough away. You give yourself a 4.6% buffer. All right, so we're going to save this trade as a bullish loaded dice. All right, and we'll skip Tesla because Tesla's kind of its own animal. We'll just skip Tesla. We have these 2 trades. So our theory is if these two companies do well, it probably means the whole market did well. But if these 2 companies do bad, one thing, it could crash the whole market. 2, if Powell speaks and says the wrong thing, it could crash the whole market. So how could we play these earnings trades safely? It's not financial advice. It's just the way I might like to do it. So let's look here. Let me show you one method. You could look here at your 2 trades because basically, like I said, you're really trying to get the money from selling that put, and these other options are just a trick to get that money in there. And this option is just a trick to uncap your upside a little bit just in case it goes up here so you aren't capped out. Really, you're just trying to sell this, but also really you're just creating stock. This is a substitute for stock. In my opinion, a better substitute because stock doesn't pay you a dividend, an income. Stock can pay a dividend, but that's another story. Anyway, so this is how much stock it's substituted. Right now, it's worth 43 shares of stock. Those combinations of options are worth 43 shares of stock. All right, so that's Meta. So that's 43 shares. And then we'll look at Microsoft. And the Microsoft trade created 44 shares. So between the 2 of them, we have 100 shares of stock. Okay. Microsoft and Meta, we're just going to say for the sake of argument that they're about as volatile as the NASDAQ as a whole. All right. So here's how we can predict that. Theoretically, we should be able to protect this. We'll paper trade it and see how it turns out. We're going to, theoretically, we should be able to protect this with one put spread, and we're going to do the GPTY method. So right here, now this is totally different. We aren't looking for any income. We aren't trying to sell anything. This is different. Okay, so in this case, we're going to do a bull or a bear put spread. Okay, and a bear put spread means you buy a put, buying at the money put, and then you sell a put that's farther out of the money. But this is definitely a bearish play. Okay, so what we're going to do, though, we're going to do kind of like they do on GPTY. And if the market just goes down a little bit, that's fine. If the market just drops 440, we're going to, 435. The first 5 points, that's just tough luck if the market drops. But then after that, we have to do some math. Okay, so now this doesn't expire till Friday. So, this is on Microsoft. We could edge with, but we're just going to use the Qs. I figured these stocks will tank the whole market if this doesn't work out. So we'll go out to Friday and we'll do like they do on, we'll put it at maybe a 20 delta. That's what they do on GPTY. That's approximately the GPTY trade. So that means if the market drops just a little bit, 2%, it's not covered, but in a big market drop, the trade will be covered. So I don't like that far of the money. We're just going to protect it at the money. Watch this. Yeah, if these stocks, okay, that's what we're going to do. If these stocks crater the market, or if Powell craters the market and the market's down 2% by Friday, this trade's a $600 winner. The market's down 3%, it's a $1,400 winner. The market has to at least be down 1% or it's a loser. There's a little place where it's not going to, it has to at least drop. It has a little bit of a break even. It has to at least drop a little bit. But that's all right. So we're going to do this trade at the same time as the other trades. Now, if the other trade, the problem is, we'll look at this, but let me save this trade. We'll just see how they work out. I'll have follow-up content on it. This is our hedge trade for the other earnings trades for MSFT and Meta. All right, so now let's talk about all the stuff that can happen. So wonder if, wonder if the market doesn't drop, but somehow just these two stocks miss earnings, but the market doesn't drop at all, really. That could happen. So it's not like still can't lose. But if these stocks cause a market avalanche, we're hoping, that the $700,000, $800,000, $900,000 will offset the loss from the other two trades. So we'll see. It just depends. Those other two trades have huge buffers on them. But, in a big market, if the market falls that far, they'll go through their buffers. So we'll see. We'll see. But they might go through their buffers. But then the other bad thing that could happen is they could both hit earnings and it could not be enough to pay for the hedge. Now, the hedge cost about $400. And if just this one hits earnings, it's a $700 winner. If the other one has a good earnings report, Facebook has a good earnings report. Well, Facebook's $700 winner if it doesn't crater, and Microsoft is a $700. They're both $700 winners if they don't crater. So what you're playing for is them both to have good earnings, make $1,400, and unfortunately probably lose $400 on the hedge trade. The hedge trade is just supposed to cover some of your downside. All right. So we have three trades, and we'll just see how they do. I love doing things like this. In 2022, when the market was in a bear market, I was buying Apple puts But in hedging it with Microsoft calls every day or every week, and lots of times I was selling spreads instead of buying options, but I was doing some kind of pairs trades with options in Microsoft in 2022, and I did great. Well, especially when I was buying options in 2022, because volatility was up, and volatility being up helps when you're buying options. But anyway, I'm trying to discover a strategy that works in 2025. That was great. That worked in 2022, but now we're at 2025. So we'll see how these three trades do together as a unit. And we'll see. If you guys, like I always say, these aren't the only ways to do earnings trades. I'm sure there's better ways, et cetera, et cetera. Okay, it's 1 minute till Powell speaks. But one thing I did want to say is, look at this. So I'm always talking about a bullish loaded dice. I don't know if anyone's realized this. This trade doesn't have to be that bullish. You could also move it in, put sell call, and you could do this trade. And sometimes there's advantages to doing it that way. Okay. Also, there's nothing the matter with this trade. I don't know what this is called, a jade lizard maybe or something, or you see this trade in books sometimes. This is the same thing. You look at this, you get a $2,100 credit on a $3,000 loss. You have a huge buffer. So this is what you would do. So what I'm saying is options can be used for virtually anything. This is an earnings trade if you think that the stock's not going to go anywhere, if you think that earnings are going to be pretty much in line, because you create a huge buffer. But you don't want downside risk. Okay, all this is, and I'm showing you right now, is an unbalanced iron condor. I just don't like iron condors because I don't want risk to both sides. Usually the market goes up and it blows out your call side. So, but you could do it in a safe manner. You could do it in a safe manner this way. You could do it in a safe manner this way. Potentially, it might meet your goals, or potentially maybe a trade like this. And now what you're doing here in this trade, you're selling a strangle because you're selling a put and a call. And you would love to do that naked if you had a bigger account. It takes a lot of money to do that. Now you figured out how to do that with a $4,000 account, and you brought in a $2,000 credit off the get-go to do it. All I'm saying is these trades, there's a million ways to do them. Just for consistency's sake, I'm going to do them. I'm going to not save this trade because I forget where the strikes were, but I'm going to not save this trade. So we're going to do all of them a bullish loaded dice, but you can also do a neutral loaded dice where you can do the same thing. You can move the break even as far down as possible, but don't make it where you have unlimited upside. You can make it where, like I did with here, where you don't lose the upside, but you don't necessarily gain more. What that does is moves more of the profit to the center. So that might be a better tactical idea depending on what your goals are. So this is just two of the many ways you can do it. And Jay Pestrochelli did a trade that looks like this in Netflix in Alti. That's how I figured this trade out. But then I started looking at it. You could just exclude this. You don't need that fourth leg. Lots of times you're just trying to get something that looks like this. So this is a three-legged bullish risk reversal, but I just showed you a four-legged risk reversal that's less bullish. I need to think of a name for it. It looks like a top hat or something, or there's been people have named that trade before. But that's an interesting trade too. All right. So let me just exit out of here. Let me just close it because I don't want to mess that trade up. I'll go back. Now let's see what Powell said, and we'll see if the market's moving. I'm trying to give him time to talk. Market time to move. But I'm going to make a separate video. But once you learn how to do these multiple leg risk reversals, you don't always have to go for a home run. I just show that one because that's the one I like. But you can also and it's probably a better idea lots of times to do that kind of trade, that style of trading, but to do it more in the style of an iron condor, where you put the risk on one side or move the risk to the outside and have the profit more on the inside. So that, like I say, there's different ways to do it. All right, so we'll take a look at all three of these trades. And now that I looked at it, I'm thinking I may not have enough. This should probably, here, I'm going to switch this. Well, I was thinking about switching this to 2, but if I switch it to 2, then this costs $900, and then I won't make any money. All right. Well, no, I should make $700 on each trade. But anyway, I'm going to leave it where it's at. We'll see where it's at. My fear is that it's a really bad miss. This thing pays $1,400, and the Microsoft trade alone has like a $3,500 max loss. So you can't protect against everything, or which one, the Meta trade. One of these trades alone, if it misses bad, has a $4,200 loss. But of course, it'd be nice to have the money from the hedge trade. It'll help offset the loss, and that's what it's designed to do. Okay, these prices are moving, so Powell must be speaking. Let's see what the heck's going on. Well, actually, we're going to look at SPX. All right, now let's get in a quicker time zone here. Shoot. If you guys didn't follow me when I started moving the strikes around, don't worry about it. I'll make separate content. I think you guys understand the concept of the three-legged risk reversal, and so I just stayed with that. So now those profit from an outsized move. What you're really hoping on those is like one of the two stocks blows out earnings, and just kills it. And instead of just making the 700 on the flat spot, they make 50% more or something. That's another thing you're playing for. But if that happens, your Q's trade is going to probably be dead. That $450 is probably dead money. But anyway, okay. So SPX right now, these are 30-minute bars. Maybe I should turn it on a 5-minute bar. All right. Well, it looks like about an hour ago, it made a low, rallied a little bit, made another low. Is Powell speaking? I have it on the 10 minutes ago. All right. Well, anyway, let's look at the 10 years. Anything moving? Federal Reserve decision and press conference. Watching. I got it turned on now.
Nationwide is more than you think. Oh yeah, they're playing federal tool.
Anyway, all right. So
healthcare costs are reducing financial surprises and good surprises. That's perfect because this cake is for your birthday. Surprise reduced. It's good cake.
Which is the reason why you're seeing a commensurate move in market.
Okay, so I don't know. Obviously, nothing happened. Fed repeats, inflation remains somewhat elevated. Okay. Well, anyway, still, when he comes out at 1:30, he could say something, or tomorrow. I think it's tomorrow. He'll come out and have a presser, or maybe it's today, and he could tank the market during this presser. So we'll see. But so now the big thing to see is Microsoft and Facebook earnings. Okay, now I feel bad for leaving you guys, for showing you that new content. Let's put on a Tesla trade, not as part of the pairs trade. Let's do a Tesla trade, and let's do something different than the normal three-legged risk reversal. I'm just trying to show you guys that really nowadays, since commissions are free and there's so much liquidity, when you find a really active stock with options or an index, you can do almost anything. Now, it doesn't mean you should do almost anything, but you can put together trades you could have never used to put together unless you had a seat on the exchange. The old days, before the democratization of finance, you had to buy a seat on the Chicago Board of Trade or the Chicago Board of Options Exchange or the NYSE or whatever, wherever you or your company or your family office was trading. You would buy a seat there and it would cost millions of dollars, but then you could trade commission free. So that's why these guys have been doing, things like box spreads, like free money type trades forever, arbitrage type stuff. Nowadays, the public can do kind of semi arbitrage or light arbitrage. It's really kind of more properly called statistical arbitrage. But anyway, that's what I'm trying to teach you. So let's look at this. Let's think about Let's go to Tesla and let's start where we always start with the cash secured put. Okay, so first thing we have to decide, and this is it when we buy one of these funds also, do we need an income? If you don't need an income, you're maybe better off to do some type of other strategy on Tesla. All my strategies are income generation strategies. They have income generation or most of my strategies at the heart of it. So here's this one right here. You'd love to just sell this one. You know, this one gives you a 4.7% buffer. That's great. You can make $1,800 per contract. That's awesome. Only problem is this max loss and this collateral. It doesn't it doesn't work for a $5,000 or $10,000 account. Why do big guys get to have all the fun? So all we have to do to make it the same trade, but for a smaller guy, hit buy put, make it a similar trade. It's not the same trade. Okay. So now we get an $1,100 credit and only risk $2,700, but we destroyed some of our buffer. Instead of having a 4.1% buffer, we have a 2.5% buffer. Okay, well, now we're going to try to get our buffer back. We're going to go a little bit out of the money. We're trying to basically just create a synthetic trade that is just like naked options, but without the risk of naked options. The guys that are wealthy that have bigger accounts trade naked options all the time. The guys on Tasty Trade love to sell naked strangles and straddles. It's a great way to get exposure to short volatility. It's not possible in a smaller. It's harder to do in a smaller account. Even if it's possible to do it, when you spend more on the trade, you sacrifice the ability to diversify, and you have some other problems. All right, so this trade right here, you have the buffers back. You have about a 4.8% buffer. You catch $766 credit. So this assumes, one, that you're bullish on Tesla because you're going to take the risk of Tesla. If Tesla drops, you're going to lose money. If it drops more than 5% by expiration, you're going to lose money. So you're bullish on Tesla, you need an income, or you're willing to try for an income. So this is a great base trade. So to make it the three-legged risk reversal, to go for a home run, we just hit buy call and we move the call strike out here to the first standard deviation hash mark, which is right around 435. Because if we move the call closer, but then it messes up too much of our credit. We'd love to have it right here, but we can't do the trade for a credit. Remember the things here we can do the trade for $104 credit, but that's not really enough for the risk. But here it's a $334 credit for $2,100 risk, about 15% for 2 days. You have a huge buffer. They're saying 3.9. I measured it. Well, yeah, it's 3.9. It shrunk a little bit when we added the call. The call cost us part of our buffers. Now our buffer's down to 3.9. Well, let's do this. Maybe we scoot these closer together and scoot this one further out. Or no, scoot them further apart. Okay, 334. Okay. I got it back. We got a 5.1% buffer. Okay, there we go. That's a decent trade. I mean, the worst thing that could happen is Tesla could go down. And if it goes down 13%, you're going to lose $2,600. But if you do any type of bullish trade on Tesla and it goes down 13%, you're going to lose money, and probably sometimes more than 2,600. That's actually not all that much. But anyway, so that's one way to do it. That's the loaded dice, the bullish loaded dice, because you're hoping for the outsized. You're moving some of the reward over here to this wing. Okay. So what else can we do? So step number 2 would be to add a sell call to make it symmetrical. See how there's buy put and sell put. And right now there's buy put on one side. So we could add sell call on the other side, and we make it a 4-legged trade. It could be an iron condor. It could be lots of iron butterfly. It could be lots of things. But then we can, if we want to keep it bullish, we can move the strike out even further. What this does is this makes it where this call we bought, it costs $4.20. That's pretty expensive. Well, if we do it as a spread, we get $2.45 of it back. So we can change the math of it a little bit. I usually try to find something like that where you get about a 5% buffer, you get about that's about a 20% income, and you have a chance at upside. That trade right there is also a bullish loaded dice. And there's nothing wrong with that trade, in my opinion. I mean, if you need an income or want an income, and if you are bullish on Tesla over the next week, Okay. If you aren't, you could do the reverse trade. I'm not going to show it now, but you could easily do the reverse trade. You could do 2 contracts on this side and just 1 contract on this side, 3 on this side, 2 on this side. There's a million variations, but the common theme of all of them is you're using options to move the break even so freaking far away from you that the stock really you really have to be wrong to, even if you like Tesla or whatever, and even if they miss earnings, they could like not have a good earnings report and drop 3% and you'd be fine. Now granted, that doesn't usually happen. They're either going to drop a lot or nothing. But anyway, I like these types of trades, and you get some of the money up front because the credit generated. So anyway, now let's look at this. So this is the bullish loaded dice, a 4-legged bullish loaded dice. Okay. So here's what a 4-legged neutral loaded dice, I'm going to call it. But I don't like when there's risk to one side. I'm going to always move I'm going to always when there's risk to 2 sides. So there's how a person could do it's a different variation on the trade. You only spend $1,900. It's a little bit less risk. You move the profit into the center. The chance of profit's now 73%. If they do have a good earnings report, at least you don't lose money. $100 is your consolation prize. That's about 8%. 8% isn't a bad return for 2 days. But what you're really hoping is that they either, move down about 4%, which would be a $400 winner. Even they move down 5%, it'd be a $400 winner. And that's not even at expiration. That's 5 hours before expiration. And if they moved up 5%, Tesla, this trade would be up $441 5 hours before expiration. So this right here would be I don't want to call it's neutral, but it's neutral, no risk to the upside. I need to think of a name for these types of trades because you could do it because this is a neutral trade. Oh, hang on. This, you could call that a neutral trade. That's a neutral trade. So, but this is neutral, no upside risk. Or neutral, mildly bullish, or neutral to bullish. But anyway, same strategy though. You're using the expensive puts. You're just trying to basically earn this money from this put and this call. You're selling those. The put and call you're buying are basically just to either cap your max loss. Well, yeah, just to cap your max loss. But the call, depending on where you put it, you can decide where you want risk. If you move the call out further, you can bring your upside risk back in. If you move the call back, you can have less upside risk. You can also look at this as 2 trades. You can look at any of these as 2 trades. Watch this. We're going to exclude the calls. You could just do this trade by yourself too. This trade has a 6% buffer, makes 760. Just don't have any upside. But if you don't need upside, this is a fine trade. But anyway, so this is a put spread. It's a credit put spread or a bull put spread. So now let's light up the other ones and we'll get rid of the 30 years moving. Hopefully the market will have moved more. We'll talk more about the market here in a second. All right. So we're going to exclude. Okay. So that was a bull put spread. These 2 options by themselves are a bear call spread. Okay. Well, bear call spread actually is also a credit. So you received a $266 credit from the bear call spread, and then you received whatever the credit was from the other side as well. It's just a compound trade. You're just putting the 2 trades together. Sometimes it makes sense, and sometimes it doesn't. Sometimes it's best just to sell the option by itself. If it's a cheap stock like on SoFi, or sometimes like on a $10 stock, you could just write the put. $10 stock can only go to zero. It's just $1,000 worth of risk. So it doesn't have any more risk. A $10 stock doesn't have any more risk than this trade does. It has about half the risk. A $20 stock with a naked option has about half the risk that this trade does in Tesla. So let's look at other ways we can look at the Tesla trade. So if we do the Tesla trade neutral, it's 14 shares of stock is what it's replacing. If we do it this way, the way Jay did it on Netflix, it's 34 shares of stocks. stock, and that makes sense. And I bet if we do it the way that I like to do it, the three-legged, that one, loaded dice or whatever, that one is 39 shares of stock. Okay. All right. So the most bullish one was the second one. And also it's interesting to look at how the percentages change. When you do this, when you do my trade, your percentages go down to 66 because you're going for you're swinging for the fences over here. You're moving some reward over to this wing. If you include this one and if you include this one and you do this trade that we're looking at, something like that, now you have a 73% chance of profit. Okay. Now here's the reason I don't like risk to both sides. You could have risk to both sides, but look at your chance of profit. 38. It just for making this one strike closer. I just don't like risk to one side. And even if I'm bearish, when the market's doing bad in 2022, I did a bunch of these with no risk to the bottom side. This is a real versatile strategy. It's more versatile than the will. I just like this strategy. Because you can't do a bearish will. What are you going to do? Sell a naked call to start a will? There may be a way to do it, but it would not an easy way to do the will. So I like this type of stuff. And like I say, it doesn't matter which strategy you choose. I don't have any idea which way the market's going to go. You guys tell me, but if somebody was like really bullish on Tesla, they would do one of the bullish varieties. But if somebody just wanted an income and wanted the highest percentage chance of profit, they would put on this trade. Help me think of a name for this trade. Bull put spread. What it is you're earning more on the bull put spread than the bear put spread. Okay, what it is the credit from the bull put spread is wider than how far the strikes are apart on the call spread. The strikes are 10 points apart. So that's $1,000. The credit is $1,100. The difference is the $142 consolation. When you put a trade together like this with no risk to the upside, you have to make sure that the call spread, the width of the strike is not more than the credit you're receiving. But like I say, I don't know if we knew what Tesla was going to do, we would know which one of these trades to put on. We don't. That's why I'm showing you all three ways to do it. You guys figure out which ways Tesla's going to go, and then and then always remember, make sure that you need an income, that you want to go for an income, that that you're going to spend this on something useful. Like if you got this $1,100 and it's a profit, you're going to pay a bill with it, or you're going to use it to live off of, so you don't have to I don't know, but it's your money. But the thing is, with these trades, you can, especially with this one, you can have fun. You can make a little credit, but you can also have some skin in the game. I just do these trades with 1/10 of 1% of my net worth. I set the loss to be 1/10 of 1% of my net worth, or sometimes 1/20th. It depends. But so that's when I say it's fun. That's what I mean, fun. Even if I lost 20 of these in a row, I would just lose 1% of my net worth. And I'm not going to lose 20 of these in a row because they have a 66% chance of profit. And if we get into a bad market phase, I'll still keep doing them. I'll just do the reverse. We'll just, it's easy to do the reverse. So anyway, all right. Well, that's all I got for you guys. The 10-year yield is going up. So that's probably, who knows? Yeah, there it is. 10-year yield. Okay. So that's not good news for the market generally. So I would expect the market to be tanking right now. All right. The market is tanking a little bit. It made a new low on the day and then bounced back. Let's see if those puts that we fake bought are doing anything. Yeah, they're up $52, the hedge trade. But our other two trades are down $90. So between the two of them, we're down $40. But the puts are making our results a little less volatile. That's the whole idea. We're trying to do a mini GPTY. This is GPTY. This is MC. This is MCFY, max convexity, or in MCTY, max convexity tries for a yield, or MCGY, max convexity grabs a yield. So we're gonna, and we grabbed a yield. If we would have done this in real life, which we didn't, $710 credit for that one. So we have $1,400. We put 14 because the other one was about $755. We put $1,400 in our account, but we have about $9,000 of max loss. We've tied up about $9,000 of margin, but we put $1,400 in our account. So we're darn sure going to take our wife to dinner tonight or whatever, save it, pay a bill. And at the same time, we're going to hope that Microsoft just kills earnings and just has a 2 standard deviation move. It happens occasionally. Look at that. A 2 standard deviation move on this strategy is a $9,800 profit. That's because of the leverage of options. I'm not saying it'll happen, but even a 1.5 standard deviation move is a good one. So, anyway, yeah, we have what's it called? MCGY, max convexity gets a yield. So our yield is 1,400. If this was a fund, if you guys had given me money and we had a fund, we had about $10,000 tied up because the puts were cheap. I mean, about $10,000 total tied up. We made $1,400 this week. So I could pay that out as a dividend to you guys. I wouldn't pay it all out, but I would pay a good portion of it out. And then, as far as the net asset value of the fund goes, well, that depends on, what the market does. And I can't control that, but anyway, but we'll see if my little hedge strategy works here. We'll see if the 2 puts can save the day if these guys crater the market, so it's only up $39 because the market's bouncing. But let's go into tomorrow morning. So here's Thursday morning at 10:30. So we come in tomorrow and it's just a bloodbath. It's down 1 or something. We're down 1.5. This option trade's a $440 winner, which is good because my earnings trades probably going to be losers at that point. That's unless one of them maybe happens to hit earnings. If one of them hits earnings, maybe the market could go down tomorrow and they could go up a little bit or still stay flat. I mean, and maybe I'll win on both sides. All right. So let me know what you guys think about MGTY. Do you guys ever try to make your own hedge fund or your own hedge fund type strategy? I was initially going to do this and put Tesla in as well and probably add another put or two, but Tesla's just so volatile. Let's just do these 2 longs against this 1 short. This is our long short strategy for this week. We could also call it MCLS, max convexity long short. All right, guys. Well, I appreciate you being here. It doesn't look like the market really. Let's check Russell. Well, I put it back on daily. I mean, this isn't probably going to be good for the market, but it hasn't cratered it yet. But that's also why I was talking fast. I was trying to get all that done before the announcement so we could see it, because I wanted to put it on paper before the announcement so we can see, how we would have done. Because I'm nervous about that. I want to play earnings. I may do something similar in real life. When I say I'm not doing it in real life, I mean not necessarily. And I've done stuff like that lots of times before. I love the Microsoft and Apple pairs trade. They both have super liquid stocks. You can sell a call spread on Microsoft when it's and buy it, put in, and you can do anything. But that's something I have done before, selling call spreads on Microsoft and put spreads on Apple, or selling call spreads on Microsoft and buying puts on Apple, or there's a jillion things. I'll make some more content like that as well. But I'm fascinated with any type of pairs, arbitrage, long, short, that type of strategy, as you guys know, any type of hedge. All right, guys. You guys have a good day, and I'm going to leave you with this one thought here. We have this gigantic gap from Tuesday morning, which is just a few days ago. It's bullish, though, at this point, on the Russell. Is that this Tuesday? Or no, that's last Tuesday. Or no, the Tuesday before last. Anyway, January 15th. It was a bullish day. So we'll see if there's buyers still there. Should we get back into it again? It looks like we may get a chance to find out this afternoon. All right, guys. You have a good day. And I'll post the trades so you guys can follow them too.